Hi, I'm Mark King, Head of EMEA Content at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA, and we're going to discuss some of the key themes driving markets. These include the year-to-date rally in risk assets, the macroeconomic backdrop, Brexit and Europe. Mark, the rally we've seen in risk assets has continued so far this year. What can we take from that?
I think what we can take from it is that normal service has been resumed. So we got quite alarmed last year by the geopolitical tensions that arose in the second half of the year, with trade policies being introduced, that slowing global growth, and investors globally becoming quite concerned by the slowdown. That's not really manifested itself in a big sharp slowdown in 2019. So growth has continued in global GDP, corporate profits have continued to grow, valuations remain relatively attractive, and that's allowed risk assets to rally. The other thing that's accompanied that is that bond yields, which rose quite sharply last year, have again come down, and it's almost like we're back to where we were during the sort of height of quantitative easing, with low inflation, low growth, low bond yields, and all of that supporting the valuation for risk assets.
So does that mean the macroeconomic backdrop is holding up, or is it more mixed now than it was?
Well, clearly, right at this moment, we've got Brexit front and centre, and that continues to occupy investors' thoughts. We'll come on to that later, I'm sure. But the geopolitical backdrop feels like it's calmed down a bit. So the trade tensions appear to be falling away. There's a lot of negotiation going on at the margin. And yes, the economic backdrop feels to be better than it was. There's no question that the global economy is slowing, or the rate of growth is slowing. And all of the leading indicators we look at show that, but we still do have growth, and that's an important driver for global markets.
You mentioned the UK there, and we are in the final stages of the Brexit negotiations. Are investors still on hold when it comes to UK assets?
Well, interestingly, UK sterling assets have been quite a good performer over the last couple of months. So sterling itself has rallied quite sharply. Sterling bonds have been pretty good performers, as have the UK stock market. And I think what the investment community is saying is that the prospects for a hard Brexit have fallen away. Now, clearly, we're in the eye of the storm of the negotiations right at this moment, and who knows where we might end up. But the consensus position that the market's taking appears to be that hard Brexit won't happen. So we'll have some form of negotiated exit, and that will soften the blow for sterling assets.
And Europe is also unloved at the moment, of course. What are your thoughts on the region?
So it looks like it's a very consensus underweight. So a lot of global investors have stepped away from European equities, and valuations have fallen to relative lows against global equities more broadly. Historically, it's been an area of the market that's been a late cycle performer. And so given where valuations are and given where we are in the cycle, we still think that the outlook for European equities is attractive.
Finally, let's talk about Japan, where we've recently moved from a strong favourite in our asset allocation portfolios to merely a favoured region. What's the thinking behind that shift?
Well, there are still a lot of good things going on in Japanese companies. They are increasingly adopting capitalism, focusing on improving shareholder returns, getting return on equity up, and all of that's very positive for Japanese equity valuations. So we still like the region longer term, and also in the backdrop, you've still got a significant amount of quantitative easing really driving financial markets more broadly. But the biggest driver to the Japanese equity market is the rate of global expansion. It is a significant exporter to the global economy. And as I've said just now, that rate of expansion is slowing. The global economy is growing at a slower rate than it was historically. That's likely to be a bit of a headwind to the growth in Japanese profits. And for that reason, we think it's appropriate to reduce the size of the overweight we have to the region. We still like it. We just like it less than we did.
Mark, thanks very much.